You check petrol prices, you check stock prices, but you're not connecting the two. Oil is near multi-months high. So tell me, if the crude keeps rising, are you ready for what comes next? That's the blind spot most investors have. Oil isn't just fuel, it is inflation pressure. And by the end of this video, you will understand how oil tightly impacts your EMI, why stock markets react before the CPI rises, why rupee weakness makes this worse, and what signals tell you this becomes dangerous. Stay till the final section because that is where the real domino effect appears. India imports a majority of its crude. Oil is priced in dollars. If oil rises globally and rupee stays weak, import costs surge. Higher import bill widens the trade deficit. Wider deficit pressures the currency. Currency pressure fuels inflation. Inflation changes the central bank behavior. See the chain. Oil, it affects the trade, it affects the rupee. Now that affects the inflation and that finally affects the rates. So that is not theory, that is macro transmission. Now, here is where it becomes personal. If the inflation risk rises, RBI becomes cautious. If RBI delays the rate cut, loan rates stay elevated longer. Home loan EMIs don't fall quickly. Corporate borrowing costs stay high. High borrowing cost compresses the growth. Compressed growth impacts the earnings. Earnings drive the valuations, and valuations drive the stock prices. Oil doesn't just hit the petrol pumps, it hits the balance sheet. Now, coming to the most important point, markets don't wait for CPI print, they anticipate. If oil remains elevated for weeks, investors start pricing inflation risk early. Defensive sectors gain the attention, rate sensitive sectors hesitate. Autos, airlines, FMCG feel the margin pressure. Banking valuations become sensitive to growth outlook. This is expectation adjustment, not panic. Markets move ahead of the headlines. So, why does this feel more fragile now? Layer in the current environment. IT sector already weak, breadth fragile, rupee soft, global risk uncertain. Now add oil rising. When multiple macro pressures stack, correlation rises. Correlation rising means diversification weakens, and weak diversification increases the portfolio volatility. This is clustering of risk. Markets rarely fall from one trigger, they fall from pressure built up. So, is this 2022 again? In 2022, oil surge and inflation spike and rate hikes have crushed the valuations. Today, the situation is different. Balance sheets are stronger, inflation is not spiraling yet, but markets are sensitive because valuations expanded expecting easing. If easing delays, multiples compress. Multiples compress without earnings collapse. That is valuation reset. Subtle, slow, but powerful. So, what should the smart investors watch now? They should watch the Brent crude trend, dollar index, rupee stability, bond yields. If the oil stabilizes, pressure eases. If oil breaks higher, macro risk rises. Not instant crash, but rising volatility probability. That is the key. If you felt this video was uncomfortable, good. Because oil isn't dramatic, it is gradual. It doesn't scream, it builds. And markets respond to build up. Most investors react to price, few track the pressure. If you want macro signals decoded before they hit your portfolio, subscribe. Because markets whisper through commodities first and oil is whispering properly.